All right. Good morning, everybody. My name is Scott Craig. I'm with Wilson Sonsini Goodrich and Rosati here in Austin, Texas, partner in the corporate securities group. I specialize in helping technology companies get started, raise money, and hopefully have a great exit, whether that's M&A or potentially IPO. If you don't know about Wilson Sonsini, we're a global law firm based in Palo Alto, and basically we feel like we're the global leader in helping innovative and high-growth companies, especially in the technology field, solve their legal challenges. I want to introduce my other panelists, John Entwistle, Charlie Plauché, and Susie Sosa. I'll let them introduce themselves, and then we'll get started. John?
Hey, my name is John Entwistle. I'm the co-founder of Coder.com. We're a seed stage company, and essentially our mission is to allow software engineers to harness the power of the cloud to accelerate their workflow.
Charlie Plauché, I'm a partner with S3 Ventures here in town. We're an early stage venture capital firm with almost $500 million under management across 6 funds, and we specialize in seed, Series A, Series B, software companies primarily based in Texas.
Hi, I'm Susie Sosa, and I'm a entrepreneur CEO. My company is called Verb, and we're an HR SaaS platform, and we help companies create a learning culture through leadership development and peer learning.
Great. So this session's called, we're talking about a Texas-sized Series A and what that means and how you should prepare for it. The first question I've got for you guys, and I'll start with you, Susie, is what do you consider a Texas-sized Series A? and frankly, is it how different is that than a Series Seed or a large Series Seed? Are there different inflection points that you consider when you're trying to go raise a Series A?
Sure. Well, I'll disclaim everything I'm going to say, that I'm not expert in fundraising, but I can certainly speak from my own experience. I think that, again, from my experience, raising money in Texas, the rounds tend to be smaller than they are in Silicon Valley. And so, a Texas-sized Series A is probably in the range of a $5 to $10 million Series A. And I think in the Valley, they can be a lot larger than that. Things are changing a lot. So I'll just say, my company, we've raised $6 million so far, and we have not done a Series A yet. So I've raised 2 different seed rounds and also a couple of convertible notes in there. So we're about to do a Series A. Well, we're doing a Series A right now. That'll be about a $6 million Series A.
John, what was your experience?
Yeah, so just to kind of give you guys some background, my company is funded by Redpoint, Founders Fund, and Encore Capital. So I have no money from Texas.
Maybe we can change that.
And in regards to fundraising, I pretty much talked to every venture capital firm under the sun, whether it be Sequoia, Andreessen Horowitz. I probably get 50 VC emails a week, them being interested in, when are you going to be out raising your Series A and all that sort of good stuff. So I'm trying to, in regards to, Texas raising smaller rounds, I definitely think that that's true. I think part of it is just sort of the size of the funds, and then also sort of, deal flow, especially when it comes to certain technologies. But I think that that's something that's definitely changing, and I think that, with more Texas funds sort of coming in and the capital under management sort of becoming, a lot greater, that we'll start to see a lot larger Series A in Texas, pretty soon.
And then, Charlie, one of the things we talked about Series C and Series A. Do you see, is there a true difference there with maybe a large Series Seed versus what we would typically have considered a Series A?
Yeah, I think the market's changed a lot. I've been in the business about 10 years at this point, and if you go back 6 or 7 years, there was not all these kind of Series Seed rounds. And I don't know, 5, 6 years ago, a lot of the coastal firms started publishing data on what was their valuation what's their average valuation for Series A. And so they want that number to be high, and so then it started this trend of all these companies wanting to have a pre-seed and seed 1, 2, 3, and all of these different things, and it's really just a marketing thing. And but if kind of rough numbers, typically a Series A company is probably approaching $1 million kind of run rate, or maybe a little north of $1 million. say you're doing a few 100,000 or something, it's typically going to be kind of called a Series Seed. But I always tell entrepreneurs, look, don't get too caught up in kind of what you're calling things. I mean, at least I personally don't care if it's a seed or an A. I mean, you could call it Series Capital Factory. You could call it Series Zebra. All it is legal nomenclature to refer to a security that's in the same class. And so it doesn't really matter. But anyway, it's changed, definitely changed a lot in the past 6,
Well,
7
and
years.
I'll just tag on that. I mean, as an entrepreneur, we went through this. So we raised a seed 1, and then we needed to raise some more money. And the question was, is that a Series A or a seed 2? And I think that the marketing piece comes into play because it becomes a signal out in the market. Like, if you raise a small Series A, or at a low valuation, it could send a signal that like something's weak about your company, right? And so for us, we made the decision, okay, we'll call it a seed 2, so we can have a bigger and sexier Series A. We also, in the early years, you know, we did several zigs and zags before we had product market fit. And I was very cautious about taking institutional capital in the early years when we didn't quite have product market fit. And I knew angels were going to be a lot more patient with me and a lot more forgiving. And I wanted to have an institutional lead on the Series A so that I could say we're backed by, you know, and have some strong venture names. And since I wasn't ready to take institutional capital when I needed that second round of funding, that was one of the reasons why we decided to call it a seed 2, because it was mostly angel funded instead of VC funded.
Totally makes sense. And let me clarify, there's nothing wrong with doing
Yeah,
that, by the way. And it is good marketing, right? You raise the bigger A, it's good for recruiting and things like that. And so, but I think some firms get caught up in, we can't fund this if it's not this, and call it a Series A. I personally don't do that, but anyway.
Yeah, I mean, my experience has been, I used to sort of have Charlie's point of view. It's, call it whatever you want. You know, the numbers are the numbers, the company is the company, but it really is a marketing tool. You know, the investors know better, but when you're trying to hire and people that have been at startups before, they can kind of understand where you're at. You know, that whole, they kind of understand those concepts, seed, A, and B. So, you know, if you have a company that's decided to call their first really small round a Series A, that's not a bad thing, but it may be harder to explain, or when you go raise your next round, you call it an A1 or a B. The marketing aspect of it puzzles me a bit because, again, it's all numbers. It doesn't matter what the docs say. It is what it is, but it tends to be important. Sorry. Well, yeah, so John, I'll ask you a question. I mean, you were new to Austin, fairly new, just a couple years ago, and you had to establish a network, and you found investors in California, but I know that process was hard for you. What did you do to try to find that network to help, whether it's directly with the investors, to help you find the investors?
Yeah, so again, just to kind of like give you guys some background, and honestly, it's always easier to kind of just start with my age. So I'm 21. I started this company out of high school, and there's not many high schoolers who know a network. And I feel like if any of you guys are going out and fundraising, you know, everyone's like, well, just get an intro, you know, just get an intro to Sequoia or Andreessen or whoever it is. And that wasn't something that was an option for me. Which means that, you know, if you can't get an intro, then you need to get in contact with them somehow. And so basically I just started sending some cold emails. I was like, you know, hey, we're this Austin company that you've never heard of, and we're doing some pretty cool stuff. And initially, there was definitely a lot of confusion, right? Because all these venture capitalists like to feel like they get all of the deal flow, right? Like if there's this new great company, how could we have not heard of it, right? It's impossible. So we were definitely very like stand out in that regard. But sort of once we started to put our name out there, and then once our product started to gain, you know, a decent bit of traction, and then we started getting, you know, maybe 1 or 2 intros from you, and you know, things started to really roll in. Basically, what happened is the venture capitalists started contacting the Capital Factory, right? Mm-hmm. They're like, you know, this is the epicenter of, you know, Austin entrepreneurship. Who are these guys? And we were not involved in the Capital Factory at all. Like, we hadn't heard of the Capital Factory. Like, we're down on the east side, just like working on our product. And, you know, Josh sends us an email and he's like, hey guys, like, you know, we should probably talk about what's going on. And as soon as that conversation started happening, that's when the term sheets really started to kind of come in, and everything just kind of fell together. But you know, if you don't have a network, first of all, I definitely volunteer to intro you to, you know, whoever you need to be intro to. But don't be afraid to reach out. I feel like everyone says, you know, like cold emails are, you know, just like don't work. But at the end of the day, and this is true with your product as well, if you reach out to someone and they honestly like your company and they believe in it and they, you know, read that title and it catches their attention, they will pull that company out of you, right? Because they could be, you know, changing their baby's diaper or whatever, and when they see that email come in, they're like, this is what I've been working for. Like, I have a thesis on this. Like, I think that this is the next big thing. And so don't get discouraged if you send, you know, 20 emails and, you know, they all get back to you and they're like, you know, hey, it's too early or whatever. Because like you will find that right partner, and when you do, they'll stop everything. They'll have you fly out. They'll, you know, like have you meet all the partners in the same day. So, you know, if you don't have a network, don't be afraid to really reach out to them, for sure.
And Susie, you've been in Austin, so what's been your experience?
Yeah, well, I had kind of the opposite. So I've been in Austin for, oh my gosh, like 25 years or something. So I have a huge network, and, you know, I haven't taken any institutional money. So I've raised $6 million from angels. And the way I did that was actually by joining a lot of nonprofit boards. I didn't have that as my intention, but that's kind of what happened. Early on, I joined a lot of boards and ended up sitting as peers, you know, with people who had a lot of wealth or were in positions of influence, and built those relationships over a long period of time, so that when I started my company, I could just call people up and be like, hey, would you like to invest in my company? They're like, oh, you're amazing. We did that gala together, or we did that fundraiser together. And, you know, they trusted me and knew me. So, you know, that's one strategy that works really well.
Well, I mean, so just to point out, I mean, those are two completely different aspects of raising money. So what works for you, or maybe it's your company is more importantly, if it works, it works. So I think people should keep that in mind. But
And just to note, if you do have a network, definitely don't do my approach. Like that is 100%. Like if you know, like managing partner at like some firm, like definitely call them up, use your connections, all that sort of stuff. But you know, sometimes you just don't have those type of connections. But if you do, 100%, like absolutely, it's the best way to go for sure.
Yeah, and so Charlie, sort of flipping that on its head, when companies are looking to raise money from institutional venture funds like S3, how should they get in touch with you if they don't know you at all? You know, what's the best way to do that, and what works and what doesn't?
Yeah, there's no right or wrong way. You know, cold emails are fine. I get cold emails all the time. People submit business plans through our website. We review every business plan that comes through that website. You know, obviously, you know, folks like Scott will introduce me to people, and those get, you know, quick attention as well. I mean, obviously, you can get a warm intro. That's really good. And I'm working on 3 investments right now. One, I met the entrepreneur randomly at a conference. Another one, I got introed by another entrepreneur in town that I know. And the third one, I think I saw a press release about the company, and I emailed them through their help site on the website, and the CEO emailed me a few minutes later. So it's really a smorgasbord of kind of ways to get to the investors, I think, and there's no right or wrong way.
Yeah, I mean, I think one of the, as a partner at Wilson Sonsini, and with our presence on the West Coast and the East Coast, we often get asked to make intros to VCs all over the country. And you know, our firm certainly has the capability of doing that, and other law firms do too, and other sort of conduits and service providers can do that. But one of the pieces of advice I'd offer is, if you tell me I need an intro to Sequoia, that's not very helpful. You know, I think folks are able to do the research on who the partners, who the associates are at a firm, what companies they're associated with. I've got a SaaS B2B company. These are the partners and associates that focus on that. That helps me find the partner that in my office in Palo Alto that knows that guy, and I can potentially make the intro. Whereas if you just want a general intro to a VC, that's tougher. Know who you want to meet, and know which VC is right for your company. Because you know, just getting intro to every VC out there, that's a question that's an ask of your service provider that's tough for them, because you know, we have relationships and we want to make warm intros, but we want to make the right intros when we can.
Yeah, it's also important to note with that, if you just contact like some random guy at Sequoia, and like you didn't do your research and you don't read his blogs and everything like that, like there's a very high likelihood that you're reaching out to the right guy. Like if you're making a developer tool and you reach out to some guy who's very interested in revolutionizing agriculture, it's just going to tarnish your reputation, and it's just going to go immediately to trash. So like the way that I like to frame it is, take a look at how much are you raising and figure out, do I have product market fit or not, right? If you don't have product market fit, I will categorize it as a seed round, right? You're raising your seed round. So find a seed investor. If you're in Austin, try to find an investor that does invest in Austin. Now for us, it's a little bit different because the first words out of Uncork's mouth was, we don't invest in Austin. And then, a few days later, they ended up giving us a term sheet. But finding people who invest in Austin is just one less hurdle that you sort of need to get over. Once you find those firms, read all of the partner bios, right? And if none of the partners have a bio that really resonates with you, then just skip that firm. I know that it seems like a little bit rough. You want to give yourself as many opportunities as possible, but it's really just not worth your time, because you're going to be trying to manage 20 different conversations at once if you do this process properly. And making sure that you manage it with people who will actually give you money at the end of it is really important. And I believe that you can tell that pretty early on in the process.
So Charlie, one question we get from our clients a lot as they're starting to get ready to raise money is, what should the valuation of our company be? And my first answer is, I'm a lawyer, I have no idea. But that being said, it's a tough question for companies, especially folks that are just getting started. How do you go about determining a valuation for a company that maybe they've got a little bit of revenue, or they've just got a great product, but it's hard to really figure out what the value really is?
We put some numbers on a board, we
Yeah,
throw
yeah.
some darts. We get this question a lot. Obviously, there's a lot more kind of art than science to it, especially in the earlier stages. As a company matures and they're doing millions in revenue, people start to kind of tie things to multiples a little bit more, multiples of revenue. Early in the earlier stage around this, seed, it really kind of comes down to how much traction do they actually have, how much money are they raising. In our mind, we're always looking. I'm hopefully closing a new investment here next week. It's a $3 million round. When I'm looking at that valuation, I'm going, okay, they've got some money in notes. That's going to convert. How much dilution is actually going to happen to the founders at these different numbers? How far do we think this money can get them? And then will they be, with some cushion, be able to raise at a nice step up in valuation? And so that's really what we're kind of juggling with. But so that there's no kind of exact way, but a rule of thumb is kind of 20 to 30% kind of dilution typically kind of in each round, and sometimes it can be more, sometimes it can be less. It kind of all depends. But some of the big VC bloggers out there would use that as kind of a rule of thumb. But it's kind of a balancing game. Money, kind of milestones to get to the next valuation, and kind of dilution to the team and everybody as well.
So Susie, when you went out to your angel group for your seed and C1, which has their equity rounds, right?
Yeah,
So you had to
yeah.
put a value on the
Yeah.
company. That's a little bit different process than going out to institutionals, right? You almost
Yeah.
need to tell them
Yeah.
what the company is. How
Yeah.
did that go? I mean, was there any feedback, or was it just, that we know you, so we're going to...
Well, I think that's one of the benefits and the risks of doing angel rounds, is that they tend to be less price sensitive about the valuation of your company. So, I drafted the term sheet at the valuation that I wanted, and I sent it out. And some people said no. They said they thought it was too high, but a lot of people said yes. And, again, it took us a long time to get product market fit. And so there were several zigs and zags. And I was worried for a little bit that maybe I had overpriced my last round. Like, would we be able to do the next one above that? But in the end, it ended up being okay. But it was not easy, in those early years when, your revenue is spotty and, your company is just sort of very ambiguous. So yeah, it is more art than science.
I would say it has a lot to do with supply and demand as well. All these venture capitalists, they all have deal flow, right? And if they aren't getting a lot of good deals in the pipeline recently, and you have 10 other term sheets coming in, you can tell them, hey, like, we have a bunch of other competing firms who are very interested. We're going to be raising more money in this round. So And for my advice, if any of you guys are going out and raising, I think that honestly it makes a lot more sense to start lower. So take the valuation that you sort of like want to get, take dilution into effect, and then start a little bit lower than that, because at the end of the day, if you have a bunch of term sheets, it's a lot easier to go to them and say, hey, we're raising more money now, and it's almost kind of an exciting thing to them. They start to feel the pressure, all that sort of good stuff. But if you go to them and say, hey, like no one bit, like we're raising, a lot less, that's a much, much harder conversation to have, if you'll have the conversation at all. So, the number that you give them initially, obviously they're going to want to stick to it, and you may end up with them moving super fast, which is a risk. But, just sort of talk to your mentors, talk to your advisors, and all that sort of good stuff. But really, at the end of the day, supply and demand is what creates those.
I always say it's very similar to like when you sell your house, because there's
Yeah.
no other house quite like yours. And so a realtor's going to come in and they're going to like look at comps of other houses that were built in your era and how many square feet and what's the price per square foot. But maybe you put in this amazing like steel staircase that you think is so valuable, or you did this, landscaping project in the backyard that you think is so valuable, and you tell your realtor like, no, I want it to be $200,000 more than what you think it is based on the comps, and you're just gonna have to wait and see, like, are you gonna get a bid for something at that price, or is the realtor right? And it's kind of the same in pricing a company. Like, you can look at other companies in your industry and you can see, what their multiples are and how those deals were priced, but maybe you think you're so special and you think you're worth more, which is usually the case. But like when you sell a house, if you price it a little low and you get multiple bids, it's usually ends up, better than if you overprice it and it sits on the market a long time and you have to keep coming down. It
Yeah.
doesn't look good.
Yeah, and the longer that you're focused on raising money, the less progress you're making with your company.
Yeah.
So you want that process to be as short as possible, price it low, get people interested, get the conversations going, and then trust me, like the power will be in your hand to begin to raise more. But unless you have one or two, or preferably 5 or 10 firms interested, you will have a very difficult time to get them to close fast. You're going to have a very difficult time getting that valuation up. So I know it's a little bit of a sting for like us entrepreneurs to cut down our company's price by $1 or $2 million, but honestly, like I would highly, highly recommend doing
Yeah,
that.
I mean, I think one of the things we see is we'll get companies that have raised money from angels, maybe not that much even, $200,000 or $300,000 on a really high valuation, and that's all well and good, but are you going to be able to go out to the institutionals at a valuation that's even close to that? And it doesn't mean your company's not doing well. It just means if you raise money at too high of a valuation because people are willing to throw you money, that could come back to bite you, because if they have the typical anti-dilution protections and things like that, or it just optically it looks bad, because people think they've invested in a company and maybe got duped into a high valuation. Obviously one of the things to fix that in the early stage is sort of pre-Series C and pre-Series A through convertible notes and safes that allow you to not put a value on the company and both protect, basically protect both sides with valuation caps and other things like that. But then the other thing, to John's point, you need to understand dilution, but in my experience, you don't want to fear dilution. Founders that fear dilution, I've found have had a harder time raising money, they can be very proud of their company, and a lot of them end up being very successful in finding the money they need, but it takes longer.
Yeah.
So one thing, Charlie, we wanted to ask you is, you diligence a lot of companies, right? You and your team, whether you invest in them or not, so what should companies expect as they're raising their Series A or their first institutional round, whatever it's going to be called, in the diligence process, both, all aspects, accounting, business, legal?
Sure. So, yeah, I mean, on an average year, we see around 1,000 different companies, and we invest in 3 or 4 of them, just to kind of give you an order of magnitude. I think those percentages might be similar, or they might scale way up for some of the bigger firms, but kind of less than 1% of what we see, we actually end up funding. Diligence process, you're typically going to have, an intro meeting, probably some follow-up meetings where, there's a broader set of the team. We're a small firm, our investment team is 7 people. So we'll do kind of a 3-quarter diligence day meeting. That's kind of our version of a partner meeting, which at this point we've probably spent hours already with the team. And that in that meeting, we send an agenda and we go through everything you think anybody would want to know. We go through the tech stack, the architecture, how does your dev process work? What are your customers? What's your pipeline? What's your org chart? Everything, competition, market size. And so those are kind of standard diligence things, and then we usually kind of move to terms after that. But you know, on the legal side, you need to be prepared for you know, attorneys to go through every document you've ever had with the company. And so issues you'll often run into with early, you know, seed stage companies, they haven't had all their employees sign, you know, confidentiality agreements or PIA documents, and or they don't have good documentation from all their option grants, and then you're running around trying to get things signed and document things that ends up dragging your fundraising process for weeks or longer if you don't have things buttoned up. So I would say, you know, I would advise you to really think about keeping copies of all your kind of your records, like you're building a data room to get acquired from kind of day one, so that you don't kind of run into those issues. Because if you're going to raise, you know, multiple millions of dollars in a priced financing from an institutional investor, we kind of have to go through all that and make sure kind of everything's buttoned up. And so preparing for that as early as possible is usually a good. good
Susie,
point.
what was your experience from a diligence perspective? With angels, it may not have been as much, but, you know.
Yeah, I don't think that was a problem. I think that, you know, what I learned a lot on my journey was more about like the pitch deck process. And I would imagine if you haven't raised money, that's probably more where your anxiety is. And, you know, one of I read somewhere from a VC, like if you really know your business and you really have product market fit, you should be able to build your pitch deck in a day. Well, in the early years, it would take me like a month to build my pitch deck because I really didn't have my business straight. I didn't really know what problem am I solving in the market, how is my product actually the solution, what is the total market size, what kind of companies are we going after, and all of those critical questions. So a lot of the conversations I was in those early years was more about like figuring out really that tight product market fit and really knowing, you know, where you sit in the market and getting that pitch deck really solid. Once you have that, like, I felt like the rest of it was easy,
Yeah,
you
fair
know?
enough.
Yeah, I think,
So-
yeah, the pitch deck is definitely very important. And when you're shaping it, one thing that I would also highly recommend is that you pitch the venture capitalists that it's okay if they say no first, because you will be a little bit shaky if this is your first time fundraising. For us, our first VC that we pitched was Google Ventures, and we had never pitched anyone before, and we were like wearing button-ups, and we're like, holy shit, you know. And it was a mess. Oh my God, was it a mess? They were so nice, obviously, but it was a total and complete mess. But if you're really diligent about it, what you'll start to notice is you'll say, like, why did they ask these questions? Why did everything go from laughs to the moment that I said that, you know, hey, rather than doing B2B, I'm thinking about going into the education market. Why did they all of a sudden get really upset at that, right? And so it's all about sort of seeing those little facial reactions and all those sort of things and going back and being like, you know what, maybe we should get rid of this slide,
Yeah.
or maybe we should kind of change the order of
Yeah.
this so they ask less questions.
Yeah.
But that's definitely very important. And to kind of add on to the diligence side, you know, for us, almost all of our investors are Series A investors in a Series Seed company, which is pretty much unheard of. Redpoint does not do Series Seed. Neither does Founders Fund. I mean, Founders Fund invests in Airbnb and those type of companies. So for us, diligence was a little bit different, and less so the legal side, because if you have a great law firm, you have to spend the money on a great law firm, by the way. Like, it will save you so much anxiety in the long run. Not plugging them or anyone, but you know,
That's
like
fair.
they did well for us. But they tested us sort of as people, like very, very, very hard. We would get back from San Francisco at 5 in the morning, and we would have an email waiting for us that said, hey, like, we found this bug in your product. And what they're looking for is they're not looking for you to respond 2 or 3 days later being like, you know, hey, like, you know, sorry about that you found this. They're looking for, like, you know, hey, we called the whole team, we got it fixed, you know, like, awesome. So that they can wake up to that and can see the type of people that you are. I'm not saying that you should put on a facade for it, but if that is the type of person that you are, if you're willing to stay up all night to make your company a success, then that's something that you really need to show them. When they send that email to you late at night with a whole list of questions, or they talk to some analyst and, you know, the analyst comes back and is like, I think this is a bad company, you need to be willing to respond and say like, listen, like this person has no idea what they're talking about. If they do, then you should evaluate the points very carefully. But if they're completely wrong, then you need to let them know. You need to be conversational. You need to be able to shape the product around it, because over the 2-3 weeks that you're going to be talking with these people, they're supposed to get a sense of you, and then if they do invest, you're going to be spending the next 8 years of your life with them. And so you want to make sure that you get to know them, but that they fully get to know you. And if you are a hard worker, you need to absolutely show it. And then when you get to the legal stuff, absolutely having everything buttoned up is super important, but your law firm will help you with that. And once a firm decides they want to invest in you, there's very few things in the due diligence process that they won't overcome, right? So like, if they tell all their LPs and everyone else like, we're investing in this company, they will invest in you. Just make sure that you don't have anything like any skeletons in the closet, but you can start to get that stuff together, during that process if you don't happen to have it done beforehand.
That's been my experience. Is I rarely see a deal die because of a legal diligence matter. Look, there can be business diligence issues that's a different animal, but on the legal side, it really is just a matter of delay and cost if you're not keeping things buttoned up from the beginning. We've got ways we can help get navigate through those issues, but we prefer to have people early so we can get them through. Get them prepared in the first place, but we understand that that's not always cost effective for the companies, and so it just you will make a choice. Do I go cheap on not just legal, on all sorts of services early on to save money, which may be the practical choice. Just know that at the end,
Could cost you.
the cost could be a little bit more. And you know what? That value proposition may have been worth it to get your company off the ground. And I'm as a large law firm that we sometimes lose business to that, we understand that. And if we can help you later on, we will. But there are costs associated with saving money on the front end, and just be aware of that.
Craig, before we go on, I just want to jump on something that John was talking about, which is you mentioned how like these VCs from Silicon Valley were really testing you and expecting you to like jump on that email and get the whole team together.
And keep in mind, I'm a first-time founder. I'm 20 years old, some random kid from Texas. So I definitely got put through a few more hoops than I imagine someone who's done this.
Yeah,
a
well,
few times
and I
before,
think
but-
what that made me think about is how, there's a really broad spectrum when it comes to venture investors in terms of culture and in terms of expectations. So, the Silicon Valley VCs, like the prototypical ones, they operate with a certain culture and a certain kind of expectations. They invest in a certain kind of company. They want to see certain kind of returns, and it's a very aggressive and kind of growth-oriented culture. And there are other VCs that are there are smaller funds, there are impact funds, like there's a whole spectrum. There are funds that take a much longer term view in their portfolios. They want to build like value companies. And one piece of advice that I got early on in this that was really helpful was write your pitch deck to attract the kind of investor that you want. Don't write a pitch deck that's going to try to appeal to every kind of VC that's out there, because there are many different kinds with very different objectives and cultures and so forth. And in fact, when you're making your pitch deck, picture that ideal investor as the listener to the pitch deck and organize it, based on what that person is going to want to hear. And like in my case, I know that I don't want those kind of investors. That's not how, I'm building my business. And so when they read my pitch deck, they're like, oh, she's, her growth rates aren't aggressive enough, or she's got too much service revenue in her business, or this market opportunity isn't as big as I want. And that's fine. I want to weed out investors that are, that are looking for that 5 to 7 year, $500 million or $1 billion exit, because that's not the kind of business we're building. And I think that can really help you not just make your fundraising more efficient, but as you said, these people are going to be on your board, they're going to be in your business, and you're much more likely as a founder to end up getting fired if you bring on a VC that is not aligned with your business goals. So I think that's something that's really important early on.
Yeah, and you mentioned, go ahead, Charlie, I'm sorry.
I was just going to say, I would make a plug for our website. We have a a link on there called Resources for Entrepreneurs. We're in the middle of redoing it, but we have a post called Meeting One, and it's basically to solve this issue. We basically say, Meeting One, you have one goal, and that is to get Meeting Two, and do not lose sight of that. Sometimes we'll have people come in and they will spend half the hour talking about their background, and I'm thinking, I don't even know what your product does yet. And so anyway, in this post, we have kind of, this is what an ideal kind of pitch deck. These are all the questions we would typically ask, and we kind of posted that after seeing a lot of people come and kind of not know what we were doing. But you're making some great points on kind of, you really got to get to know your investor. You need to spend as much time with them as you can. I mean, I'm taking these founders out to dinner. I'm trying to spend as much time with them as I can, and then really sitting down with a financial plan. We also have a free financial model anybody can download, and kind of a good template for building out your financial plan, but so that you're in agreement on the plan before you kind of move to the next steps.
Yep.
Yeah, and so you mentioned impact investment. Again, that's sort of a different investment thesis than you'd see from like an Andreessen Horowitz or a Sequoia.
Yeah.
There certainly are some great VCs out there, but talk a little bit about that and how that's different.
Yeah.
And why it's good for your company.
Well, and one thing that some people don't know is like the way that venture capitalists get their money is they raise it from other sources. And so they raise it from pension funds that are looking to invest, retirement money, other institutions, and some venture funds are actually raised from individuals or from family offices. So where they get their money from really significantly shapes like how they invest that money, because that's their boss, right? So there is a group of investors who have as their thesis that they're going to do social good while making money, and those are impact investors, and they may commit to very specific social impact goals like reducing carbon emissions or increasing educational outcomes. Some funds are very narrow by sector, and other funds, are broader. But what's different about them is that they want to invest in companies that have social impact that is in parallel with the financial return. We're a social venture, and one of the things that is different about social ventures from just like a business that has a philanthropy program is that they expect you to track your social impact metrics at the board level. So it's not just like, we sell our widget and then we give 3% of our profits back to philanthropy. That's not considered an impact business. An impact business is actually solving a social problem while you're making money, and there are investors that are looking specifically for those kinds of companies out there.
Okay. John kind of talked about this, but Charlie, I want to ask you as well, because S3's invested before, after, alongside funds that are on both coasts, all over the country. Is there a certain type of if you're looking for investment outside of Texas to kind of, whether it's your first investment or to complement some Austin or based or Texas-based investment, what are the, I guess, key features you see in VCs that have been successful in Texas that are outside of Texas? Because obviously some don't invest here at all, or some have not done well here. I'd be curious your thoughts there.
First and foremost, I think John had some good advice earlier about kind of finding partners at firms that are interested in whatever vertical that you're in. The number one thing I tell our companies, we help our companies raise outside rounds all the time. We help them build pitch decks and give them investor list, and we will actually go do the research you're talking about and say, they've funded deals like this that might help you and try to make intros and things. But the number one thing we look for is, have they funded companies in Austin? Because if they have one company in Austin, it is way easier becoming the second company than it is becoming the first. And it's simply, they're busy people, and getting on a plane to fly here, and it can be 8 or 10 years you're committing to fly somewhere, is a big commitment. And so if companies don't already have investments in Texas, they're usually not even on our chase list. And you've seen a lot of companies, coastal firms, some of your investors be an example, that have come to Austin recently, which is a great thing. I think it's probably the best time to be an entrepreneur in Texas as it has ever been, from the number of local VC firms that are around today, and also the number of coastal firms that are investing in Austin. But those are kind of the number one things. Kind of, are they investing in your vertical? Do they have investments in Austin? I don't have a magic answer for how do you get them to make their first investment in Austin. I don't know that I've worked on one of them that's done that, but yeah, certainly if they have one or two here, that's a much easier hurdle to get over.
Yeah. So as a company who the majority of the investors, we were their first company in Austin.
He's got the magic answer. Right?
Yeah.
It's definitely a hurdle. But at the end of the day, if you find the right partners and they want to invest in your company, you could be in Timbuktu, and they will invest in your company if they think that you're going to be the one to get them that return of, 3, 4, 5 funds, they're going to be very happy. But it is difficult. And like I said, in our first pitch meeting, our first investor, when we were talking to him, he's like, just so you know, we don't invest in Austin. And I'm like, well, I'm going to show you what we have, and then you can tell me. But it's definitely very hard. But there are a lot of great firms now that are like first round. I know I was actually talking with one of their partners who was here yesterday. They're investing now, and if you run a seed stage company, they're absolutely great. So it definitely is becoming more and more of a thing to get Silicon Valley money inside of Austin. And if you do run a very technical company, or you have that product that you pitch the local VCs and they just don't seem to be getting it, that doesn't mean that you have the wrong company. It just means that the partners aren't necessarily interested. And so it's very, very important that you don't just stop because you're like, none of the Austin VCs seem to understand what I'm doing. Because there will be, those few investors who are experts in your vertical and will understand the value of what you're building. So definitely don't get discouraged if you're trying to raise money here and you can't find the right partner.
I had that experience intensively where, we're an ed tech platform and we were pitching to some of the Austin VCs and they were just like, they didn't get anything about the market. And
I would say it wasn't me. I don't think we've met.
No, it wasn't. But and it was so discouraging because they were just like, we don't get it. Who would use this? Who would buy this? What is this for? And I was like, what's wrong with us? Why don't they understand? And then we went and pitched to, we got introduced to a couple of ed tech VCs that only invest in education. And they were like, oh my God, you guys figured this thing out. We've been looking for so long for someone to figure this out. And I was like, okay, it was such a different experience, and it can be really disheartening when you pitch your company to someone that just does not know your market or get your product, and you walk out of there thinking, because they're often pretty cocky, and they'll make you feel like you don't know anything. And so if you can find investors that do know your category, that's a really great benchmark.
Yeah, no, for sure. And making also sure that even when every time you pitch someone, it's a learning opportunity. So even if they do kind of shit on your business and shit on you, it is a learning opportunity. No, it really is. And honestly, those are some of the meetings that I was most grateful for is, having these guys who have run companies and exited for billions of dollars, spending 30 minutes with you to just give their opinion. Every single pitch is a learning opportunity. And I promise you that if you really focus on what they're saying, that you will walk away from it having a better idea of your business and sort of understanding what next steps make sense. So never just dismiss their opinion entirely. But it is a massive learning opportunity. And so even if they have no idea what's going on, even understanding the questions, because again, it's maybe I can convey it better, so on and so forth, but you definitely will have some messy pitches. Oh my God, yeah. And you just got to be willing to kind of laugh it off because, it's just part of the journey.
Yeah, I think one of the things that I've seen in the press, and it's starting to come to fruition, but I'll be interested to see what happens in the next 2 years, is the Valley funds have actually talked about how they need to invest more outside the Valley. I think, John had this experience, but we see it all the time when our clients go up there to do the road show on Sand Hill Road. They say, you're great, you're awesome, we love you, we love your team. You need to be up here. And that's changing. And I think that's going to be great for a place like Austin. Obviously, a lot of these companies, these large companies in Seattle and the Valley are opening what are essentially HQ2s here. And that's going to bring talent. It's going to also compete against startup companies for talent. I mean, it's tough for a guy to take a low salary and equity when Facebook wants to pay them $200,000. So
I think being in Austin has helped me. There are a lot of funds in the Midwest that are not on the coast that specifically say we don't invest in the coast. And so I feel like it's actually an advantage when they say, where are you from? And I say Austin. I'm like, oh, great.
It's gotten a lot better. I mean, I was literally at a dinner last night with some West Coast VCs that set up the dinner just because they want to talk to us about investing in Austin companies. They do not have an Austin company right now. They're like, what deals can you show us where we can participate? Another one I'm working on right now, there's multiple large West Coast firms, and they're wanting to write checks for a few $100K, legit seed checks. So I think the flywheel's going, it's not stopping, so it's really a good time to be raising.
Well, we've got a few minutes left, so I thought I'd open it up to questions. Over there?
Yeah, I just wanted, same topic, but I was wondering, did you get pressured, John, afterwards to say move to the valley?
So when you're pitching them and you're pitching them that you are in Austin, selling Austin is something that you have to do. You know, they definitely want you to be in the valley. They would prefer if you were in the valley because they don't need to fly. You know, they can just, you know, drive over and it's perfect. So when you are pitching them, you do need to sell them on Austin. Like that has to be part of your pitch because they're going to ask, why did you choose Austin? And you have to have a good answer. It needs to be very, very passionate. In terms of pressure.
So what's your answer? Like, because you could have moved to the valley.
Yeah, no, I mean, yeah, for sure. So our answer is that it's all about the people. You know, our guys are working every night until, you know, midnight, which I know isn't like a very like popular thing right now, but we have a good work ethic and we are very proud of that. And no one's being forced to work late. It's just we like our office, we like our guys, and you know, we're having a good time. And so for us, it's really about the people because a lot of the times in the Valley, you know, you will get those people who are all in it for themselves. You know, they have their Facebook stock, which is, you know, fully vested, and, you know, they're kind of like, I'll just cash it out. And, you know, but like the people here, they actually want to build something. So that's my answer is it's about, you know, building something great and building it with the right people. And then also it's very hard for them to argue with the fact that it's a hell of a lot cheaper here than it is in the Valley. But don't start with that because there's no passion in that answer that it's just cheaper. But that's 100% something that you should practice when you go out, you know, and start pitching is why are you here? Because it better be deliberate, otherwise they're going to be very disappointed.
Yep.
It's just an incredible panel, one of the better ones I've actually attended. That's all my questions pretty much.
Okay.
But talking about being outside the valley, I'm actually based in Ireland.
Okay.
So we're here for Southside. So we're a little further away again. And we have a B2C product, so we took our time, we bootstrapped up till now, just to really get where we can get it. And then since December, it started to go sort of viral, and users in
Awesome.
84 countries already. So we're thinking global. I don't see us as an Irish company. I see us as a global company. Do you guys recommend we already start talking to, so we're raising pre-seed?
Right.
Should we be talking to people in the States now? Because we had advice that we should raise at home, but I want to move fast and just accelerate a little bit now.
You know, I can only talk from sort of the legal side, and I'm not going to pitch us, but I just what I'd say is, I mean, where do you want to raise money from? And if you want to raise money from the U.S., it's important to have advisors that can help you with that. And help you navigate U.S. laws, navigate U.S. VCs. Now, there's plenty of money in the UK. I mean, I don't know how Brexit's going to affect Ireland, for instance, but you know, there certainly is availability there. Now, I think having some, you know, B2C is a little different, but having some revenue traction always helps when you're over here. But you know, I'd defer to, you know, Charlie a little bit, you know, as far as foreign, but having a presence here is going to be important at some point. Yeah.
Yeah, it's just another hurdle, and that's really the tough spot for you.
And some, you know, US-based firms have funds and allocations of funds that focus internationally. Like your firm's in Austin, likely nobody would invest outside of the country, and most of them have a Texas-based thesis and things like that. And so you just have to find the right fund. There might be wealthy individuals that would put money in an Ireland company, but none of the local firms, at least in Austin, would. And even in the coastal cities, you need to find one that has a strategy of investing internationally. But I've looked at companies that are international and they're willing to flip over to a US C Corp and make that a subsidiary, and then they're going to set up an office in whatever city, and then that's a different strategy. But
The mindset here is totally different.
Yeah.
The money, the amounts that people talk about. I was in San Fran in September, got invited over to this female founders day, and it was incredible. Like they were like, you need to reach 2.5 billion pre-seed, and that wouldn't even be like nobody's ever talked those numbers.
Yeah, it really is just another hurdle, right? Like at least with Austin, they can say I can fly out at 8 in the morning and I can, you know, be home by, you know, 9 p.m. But if you're talking about Ireland, it is a really, really tough spot. So I would if I was in your shoes, I would be trying to get, I don't know how many billionaires there are in Ireland, but I would be going down the angel route, and I would be going down it very, very aggressively, because getting institutional money from the States and Ireland, especially from like typical VCs, is going to be very, very hard.
Or London, there's
Yeah.
a lot of money in
Yeah.
London. But in the early stage, the reason they all want to get on planes is because they know that, you know, your company, those early years, there's a lot of questions that come up and things change a lot. And maybe what you thought was going to work suddenly doesn't work, and you hit 1 million, but you can't get to 5 million. So they're a lot more hands-on in the seed and Series A stage than later rounds. If it's just growth equity, they don't care where you're based because you have your business model figured out. So that's why that travel time is so important, because they're expecting to spend a lot of time personally with you, helping you.
Yeah, it's also expensive, and they just don't feel like spending a week every time they want to go visit you. I mean, it's like it's hard, but they have so many companies. It's just, you know, it's just the truth.
Let's chat after. I've got someone I can introduce you to that I think will be helpful.
Yeah.
Do you have a question?
Sure. Not a question. Firstly, great panel, very insightful. I'm sort of Scott's counterpart in Germany, so I'm a venture capital lawyer in Germany. And I just wanted to shed a bit of experience relating to U.S. funds investing into Europe. I agree. There's a lot of money in London. They're probably a bit too early with seed to have U.S. investors. There are U.S. investors that have their international programs, but that will be Series A starting. So I think if you want U.S. money in a seed environment, you probably have to relocate.
Yeah.
If you want Series A money, then you can stay in Ireland, get a billionaire to invest, ramp you up a bit, but then you'll be able to access at least some U.S. money. So the vast untapped source of U.S. money that doesn't go to Europe, but there is significant. So I think you would have a chance to do so. But seed is probably too early. At least from a German perspective, that's what we see. You know, seed companies in Germany don't get U.S. money, but Series A. So
Which I know is, like,
Billionaires are
disheartening.
handy.
Yeah, no, I know that sounds
Gotta have them on
disheartening,
speed dial.
but don't be discouraged at all.
Yeah.
Like you may have to stalk a few like old guys and, you know, like whatever. But like at the end of the day, it's all about hustle, whatever it takes. But don't get discouraged about it, for sure.
Yeah.
Question for Charlie about valuation. So this is the thing that just keeps me up at night as we're talking about a Series A round. Do you more want to see it? Excuse me. Do you want to see a company coming in with this is what we're looking for from valuation, or do you more want to discuss the company and horse trade around it?
I mean, sometimes entrepreneurs will maybe say that this is kind of what we're expecting, and that can kind of maybe, that's quick, you can not spend time wasting if that's where your expectations are. I would encourage you to kind of let the market set the price and just see what they're willing to come back with. And, you know, I say it's more of an art than a science, but the reality is if you went and pitched all the VCs in town and you got term sheets from all of them, it's going to be pretty close on the terms and where the valuations are. I mean, but I would let them come to you with the price versus. I don't typically ask that question in meetings, like what valuation are you expecting? But sometimes people offer it up, and if you've raised X amount in a note, sometimes the notes will have caps on them, and those are kind of guiding numbers. But
Yeah.
I view it as a trick question, because I've been burned before where they asked me and then I said a number and it was obviously too high, and then they didn't want to talk to me anymore. And I was like, wait, everything's negotiable, you know? So just don't. I would say, why don't you tell me?
question.
And if it's too low, you can deal with it. But
Yeah, so in my experience, like VCs, like honestly, they want to do as little work as possible. And if you, in my experience, if I told them to put a value on my company, they would be like, you know, like when you put a value on your company, they love turning that stuff around. Also, if you're ever in a pitch and they like, you know, tell you a problem and you're like, how would you solve it? That is the worst thing you ever want to say, because they will immediately come back and be like, that's your job, bro. So don't give them, like, in my opinion, try to do as much work as possible. Undervalue your company just a little bit. Again, facial reactions are really great because it'll be like, yeah, everything's good. Like, what are you thinking? But one of the best pieces of advice that I've ever got was when you're raising, tell them how much you're raising, and they can kind of do the math from there. You know, if you're raising, you know, $10 million, they're going to be like, okay, they probably want to dilute 20%, give or take, because that's how much we need if this exits for $10 billion to get our fund back, yada, yada, yada. So that's another like very good approach, is just to kind of tell them what you're raising, and how much your company needs is a much, much easier number to get to, because you know what your company needs to raise to get to the next milestones.
you should definitely know how much money you want to raise.
Yeah, for sure.
And it's like it's a kind of triangulated problem, because you can't just arbitrarily say, oh, we want to raise 10 million. Well, what they're going to want to know is like, how much revenue are you going to be able to book off of that 10 million, and what's your valuation going to be 18 to 24 months from when you take the money? And if you're not growing fast enough, then you can't raise that much money. So you don't just get to arbitrarily say, oh, I want to raise 10 million, they want 20%, so my company's worth.
Right.
No, you've got to look at like, what is a, you know, a realistic growth rate for you,
Right.
18 to 24 months from
Absolutely.
taking that money? How much more revenue are you going to put on the board? And make sure all of those pieces work, and then you pretty much find out where you are.
Yeah.
Yeah.
I don't know if there's more questions. I'll let the South by staff kick us off if we need to.
They gave me the
quit.
5 minute.
They did?
A minute,
Okay, I missed that.
like a few
Okay,
minutes ago.
okay,
Yeah.
okay,
So we
great.
probably
Well,
have one more.
Yeah, I mean, I think one thing, there's a VC in town that gives a speech all the time, and I think it's just telling when you're going to raise money, and if you're raising from institutional VC, you've got to understand your exit strategy. And I think there's a lot of companies that have great ideas and actually may have a great product, but they have no idea what their exit strategy is. But you know, the guy, what he'll say is, you know, look, if you're coming at me with a $9 million pre-money valuation, and I'm investing $1 million in your company, I'm expecting you to have a plan to be a $100 million company or more, because I need a 10x return. And obviously, venture, you don't hit every company, but there needs to be a clear plan, you know, in that kind of framework for them. I mean, if you can't explain to them how they're going to make a 10x return on your company if things go well, you know, you need to go back and figure that out. Or maybe you're not a high growth company, which is perfectly fine, but
Yeah.
that's probably not a venture play. I think that, and you know, there's plenty of companies that have been super successful, can get cash flow positive really quickly with low overhead and not have to raise a lot of money. That's not a venture capital. That's not a company that, you know, necessarily needs to raise venture capital money. I think keep that in perspective. Know where your ultimate goal is. Am I going to go public? Am I going to sell for $100 million? Or am I going to have a revenue run rate and just spit off cash and be able to have this company forever? And that's great too, but it's not a company a venture capital
Yeah.
firm would want to invest in.
So we have kind of like a very good insight in terms of like what these investors are looking for in Series A, because we're a Series Seed company with Series A investors, which is a little bit odd. But what was shared with me basically is that, you know, it's not even the $1 billion companies that start really making like a Series A fund. Obviously, they're going to be very happy with that. But like what they're looking for is that like $10 billion exit. Now, as a seed company or a Series A company, you know, saying like we're going to become a $10 billion company, it's hard because you're not even sure, you know, where you're going. That's when your vision is very important. Because at the end of the day, they're buying two things. They're buying your vision and they're buying you. And so, you know, making sure that if you're sort of pitching in, you know, for the Series A or, you know, big Series Seed, you know, your vision needs to be very, very strong and sort of unwavering. And that is what they will be buying, because at the end of the day, they know things are going to change.
I would just add to, and to Susie's point earlier about kind of knowing your firm and what their strategy is.
No, absolutely.
That is very true for some West Coast VCs. I mean, we're in our 6th fund. We've had some success. We've never had a $1 billion exit. And I think the viewpoint of a lot of the Texas-based VCs are, we need to be able to make money at $100 million exits and $150 million exits. And yes, we have some companies that we think will get to the $1 billion kind of number, but with the fund sizes in the 100 million range, it's just different dynamics than these big firms that raise $1 billion. And
Yeah.
so you need to keep that in mind when you're trying to go raise coastal money.
Yeah, I would say that. Like, I've been pleased to find, I've been in conversations where they're like, don't even pretend you know what your exit strategy is, because you don't know. And, or, you know, don't even start talking about that. Like, let's just talk about the next 4 years and how quickly you can get out of the gates and like really getting traction. So, but it definitely depends on what kind of institutional investors that you have. If you have a classic Silicon Valley VC fund, you better be, you know, confidently talking about $1 billion to $10 billion in a believable way. But, you know, if you're having investment from a smaller fund, or, you know, they're open to other strategies.
Yeah,
So.
and they totally know that you have no idea what you're talking about when you're like, yeah, my seed company is going to be worth $10 billion. But what they're looking for is excitement and passion. And at the end of the day, if you truly are passionate about what you're doing, like you'll start to honestly even convince yourself if you're skeptical.
Yeah.
You say it enough times, you're like, you know, like, we can do this. Like, fuck, I know it's so
Yeah.
hard, but we can do it maybe, right? Like, you'll start to believe it and they'll believe it too. So yeah, but yeah, I mean, no one believes, like, if someone's like, you know, what's your exit strategy? It's like, you know, we're gonna IPO at this price, at this revenue. Like, that's, like, there's no way they're gonna know that, but they do want it they want to know that at least like you believe in your concept and your vision, and that they can kind of fall asleep dreaming of, you know, the $10 billion exit.
Well,
Yeah.
anything else? I just want to thank our panelists, Susie, Charlie,
Yeah,
and
it was
John.
fun.
This has been great. And the hope is that next year, the year after, we're going to be doing Texas Size Series B, and we'll have just as big a crowd or a bigger one. That would be
We'll
great.
do Series B as well.
Yeah, there you go. Thanks, everybody.
Thank you.